Okay, good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. It is Wednesday, November the 5th. I'm delighted to be joined by Clay Siegel, Senior Fellow in Energy and Politics at the Center for Strategic and International Studies, joining us here in town for the ADIPEC conference and other matters, but from Houston in the US. Matthew Wright, Senior Freight Analyst at Kepler, and Peter McGuire, CEO for Australia at trading.com. Thanks, gentlemen, so much for joining us. Lots to talk about. I've been at the ADIPEC conference for a couple of days, as I'm sure one or two of you have as well. Lots of commentary coming out of that. Clay, let me go to you first and welcome again. You've been there at the conference for a couple of days yourself. Many things to take away, but what has your sentiment been on the sort of projection, if you like, for oil prices? You know, that the sentiment you're getting for next year. I mean, we kind of know what the fourth quarter is probably going to deliver. Next year, not looking as bearish as. Can everyone hear me? Yeah. Sorry, Clay, you're on mute. Clay.
You're on mute.
You're on mute, Clay.
He
You
understands. Yeah.
know, but you can't come off mute. Okay, all right, we'll leave you alone. All right, then. Let me go to you, Matt, then, while Clay sorts out his audio. Again, you know, the forecast for next year from, a sort of, I suppose, trade flow point of view, the sentiment I took away the last couple of days was, demand's not actually looking too bad next year, as it hasn't even looked as bad or materialized this year. And that this sort of short-term glut, the short-term tightness may actually also not change to a glut in the first half of next year, as many have been predicting. I mean, what is your takeaway from on the water, if you like?
Yeah, exactly. And I think that sentiment is sort of becoming absorbed into the market a little bit more. I mean, I think over October, when we saw, and now we're well into November, we've seen a huge amount of oil over the last 2 months. So the fact that we are where we are with prices is a pretty good sign that we're not that demand is holding up better. I would be a little cautious about Q1. I'm of the opinion that actually Q1 is going to be the real test. Q1 is going to be the test because this oversupply is, when you look at balances, this is where this is sort of going to continue now. So we need to continue to see buying from the likes of China and India at above refinery run level rates for prices to stay where they are. So I think Q1 is really going to be the proof in the pudding.
And that was also another topic. You know, China has been propping up the market quite significantly recently, especially with its inventory buying. Again, opinion on that differing whether that will continue. But that is something that the market has got used to, as well as, let's say, the $5 of geopolitical risk that's also built in. So many factors there that could change. Peter, good morning. Let's go to you on that. I mean, oil's still lagging behind other hard assets, commodities, etc. One speaker yesterday saying, though, actually, relative value, historical value to gold, it's not doing too badly. Again, sort of, we had the CEO of Vitol yesterday saying average $60 probably next year if they had to sort of put a number on it. That's a bit lower than this year, isn't it? So bearish tone going forward?
Absolutely. Lovely to see you, Diala, and greetings from Sydney. Yes, I think so. I'm building on what Matt said. The Q1 is going to be the litmus test. We all understand this positioning, what OPEC Plus delivered in the last week, understanding I think the framework as far as also the mighty US dollar. That US dollar, we've got to be conscious of it. It's now broken 100, Diala. It's bounced from 96.8. It's had a very strong, this is all in the last couple of weeks, a very strong run up. Over 100 now. Currencies are being crushed. You got yen. We've got a new prime minister there. So there's a lot of movement as far as FX space and certainly some of these commodities. Also, one must consider the gold market down the best part of 10+% from its peak. Is it going to bounce again? A couple of things that we're going to be conscious of. Fed printed 3.4 billion today, and they did 7.7 billion yesterday. That's $41.5 billion of printing they've done in the last few days, the biggest money printing in probably the last 3 to 4 years. So that's, you're talking about where the Fed's at, where dollar is, and also equity markets. We've had a big washout today on the Nikkei, down the best part of 2.5% odd, but it hit 52,500, Diala. That Japanese market is on fire. So I think there's a lot of moving parts. People are saying we're stretched with earnings, we're stretched from an equity standpoint. What's that going to do to naturally the economy and from consumption? So I think that we've got to get through those points by the end of the year to get a true indication of where we set ourselves up. As Matt said, Q1 will be the decider, and I'm interested to see where it all falls.
And I mean, Q1, Matt, is also when OPEC this week, on the weekend, declared that they're going to reverse, at least for now, what they have been doing, obviously, and not add any more barrels to the market for the time being. They meet again in December. Obviously, we'll see what happens then. But probably, I mean, what do you think is behind that? Is it more, okay, the strategy of what they wanted to do is now done, and that was always their plan, and obviously the market's still looking a bit soft in a sense from a price point of view, or is this spare capacity issue now becoming more of a factor? Is that messaging about spare capacity? Is it reality? Where would you see that? What's the thinking, do you think, behind the recent decision?
Yeah, I mean, I would hesitate to try and speculate as to the workings in OPEC, but my view is I think there's a bit of a reality check in terms of they have a good understanding of where the market's at in terms of balance. And I think there's an awareness that, for example, 2 weeks ago, crude was on its way into the high 50s, and then the US slapped sanctions on Rosneft and Lukoil, and it shot back up to 65. So, as you mentioned at the top of the call, like that geopolitical risk is really an important component. And I think they're aware that potentially some of those factors are going to start to unwind, particularly the US sanctions on Russia. I think that is going to start to reduce slightly. So I think there's an awareness that I wouldn't say they've necessarily got to where they've achieved. I imagine that there's more unwinding, but you're absolutely right. There is fundamentally now going to be a lot less spare capacity in the system. So I think it's a case of they are aware that next year the balances are going to be pretty long if they continue doing this, and that will then start to work against their agenda.
Yeah, and I suppose doing this for a while gives them that more secure cushion, and it gives the market the messaging that spare capacity is not going to be such an issue. Let's sort of give that messaging back, that there's still that cushion. Clay, I hope we have you with us now. Good morning and welcome
Inshallah.
again. Inshallah, as they say, a long may it last. On that topic of what Matt just mentioned, sort of sanctions and the US and Trump sort of being more stringent on Russia more recently, when it hasn't really been that strict. Let's be truthful. How is that marrying up with Trump's desire for low oil prices? I mean, when you start making the market nervous about 3 million barrels a day of Russian oil, you're not keeping prices down. So what do you think has triggered that now, from your interpretation?
Sure, and thanks again for having me. I think that the gloves have not really been taken off by Trump against Putin. I actually think that the gloves are still on, if you will. And until we see some meaningful implementation, I think the market is actually right to be sanguine and to not expect any material disruptions beyond the first, let's say, month and a half or 2 months, where there's going to be a little bit of a risk-off attitude by some of the traditional buyers, to be sure. But I believe that that's going to be a temporary condition. And this new sanctions against Rosneft and Lukoil is going to follow the same pattern that we've seen when new sanctions and other measures have been introduced since the war really started in 2022. And so we see with each one of these tranches, the initial worry by the market that we could lose 3-4 million barrels per day. Then, as the EU import bans came on, the G7 price cap came on, as OFAC, the U.S. Treasury Department, put its first sanctions on vessels. With each one of these milestones, we actually have this in a chart in a paper that we published last Friday. With each one of these milestones, there was an initial widening of the discount for Russian crude, say Urals primarily. And then as the market found its workarounds, as the market perceived, I think correctly, that enforcement was going to be lax, the status quo more or less reemerged and those discounts shrank for what
Yeah.
it's worth. I think the pattern is going to follow in this case as well.
Okay, Peter, back to China. We have one headline about China and India pulling back on LNG imports, but as Matt was mentioning, it's been importing sort of, I suppose, historically high volumes of oil at these great prices. They're pretty fair for China. Stocking up on inventories. A lot of people saying, how much more inventory capacity does it have? But also, Peter, in the last week, we saw it announce its new 5-year plan with a new focus on economic growth, and the economic sort of resilience came back into the language. How seriously should we take that in the context of
Well, the plenary, I think, Diala, what fell out of it was the internal demand. They're very conscious, and since then also you've had APEC, which really gave some, I think some meat and potatoes to the President Trump, President Xi situation as far as rare earths, and flowing from there naturally tariffs. Now they've been renegotiated with a discount back to 47%. So when we take on board the domestic issues as far as China, you've got to be focused on, naturally, one of their largest industries, if not its largest, is housing. We understand the overhang we've had there. Then we've got to look at the internal demand to try and foster and get manufacturing and get the I think the engine really moving in a far brisker pace. But this comes down to, where are they going to export those goods to? So as President Trump wants to bring manufacturing home, and naturally it's probably going to take a fair bit of the heat out of the market as far as rare earths as well over the next year or two, then all of these factors need to be, I think, understood and appreciated. And it's a war for energy in a lot of ways. And we understand their electric demand, what they're doing as far as coal-fired power plants, and trying to remain as youthful economy as they can. But I think it's going to be a very interesting 2026 for China.
Yeah, absolutely. This year it's been steady, one could argue, and as expected. But next year will be quite telling. Matt, give us an update on sort of tanker rates and what you're seeing on the water there. No disruptions continuing to be the case due to geopolitics. Everything looking settled into Q4. Any surprises that we might be expecting on that front?
Yeah, so there's no disruptions as such, as you said, but the freight rates are very, very high. And fundamentally, that's just a reflection of the very high amount of demand and the crude on water. So last week's VLCC rates actually hit the highest point since 2020. About $125,000 a day. So that was a bit of a short-term spike. As with anyone familiar with freight rates, you'll have these spikes and then they'll retreat slightly. But I would say we're at a point where we're likely to see over $100,000 VLCC rates on average for a little bit of time. We'll have periods below, but they could stay up at those levels. It's certainly possible. And sort of the main reason for this is, yes, we've got a lot more crude coming out of the Middle East because of OPEC plus supply additions, but we've also got a lot of demand, a lot of buying of Atlantic Basin crudes, which is a much longer voyage, so it takes up more vessels. The ton miles are higher. So Brazilian, West African, even US crudes going into Asia. The arbitrage there has been fairly workable over the last on and off over the last 3 months. So collectively, it's a very strong story on the VLs. And then when you go down the sectors, the Suezmaxes, the Aframaxes, they all have a bullish narrative there as well. Whether it's CPC from Kazakhstan going to Asia, or more Brazilian crude coming into Europe. And then on the Aframaxes, of course, it's Russia. While we talk about the sanctions, the concerns and about whether India is going to continue to buy Russian crude, fundamentally, we're seeing very, very high levels of Russian crude exports because of the drone strikes over the last few months. And that has really pushed up crude availability, lifting Aframax rates to sort of the highest point this year. So it's across the crude and the dirty tanker segment, it's a very bullish story.
Okay, great. Clay, back to you. Talking about sort of US crude and Atlantic Basin crude, with the US participating in that, We've had a lot of talk also in the last week out of ADIPEC and others that, this, of course, Trump's sort of push to expand US production, to get it out into the markets. It's beginning to sort of even impinge on some Asian markets and replace other suppliers. Where's the trajectory for US production, do you think, as we look to next year? It's about 13 and a half at the moment. Should we expect it to remain there? And are tariffs impacting that industry at all in terms of parts, et cetera, and cost?
Well, let's start with tariffs. They're certainly affecting the cost profile. But if anybody in the oil and gas industry is hoping for some relief from today's expected decision from the US Supreme Court about Trump's tariff imposing authorities, it's not going to be to bring any relief on the sectoral tariffs like steel, copper, and stuff that's really important for the oil patch. This is really about the emergency powers that Trump may have exceeded in the reciprocal tariffs. So pretty much the country by country setting of those levels. So the steel and copper seem like they're here to stay. This is the number one concern that folks that we speak to in the oil and gas world have about the trade war. And if there was one thing that they could change, it probably would be some exemptions, even if they're time limited on the steel tariffs, because that goes to the bottom line. The production outlook for next year, I think, is a bit bearish. I think that we will see the oil field activity slowdown that has begun sort of in the second half of this year is going to ultimately result in a reduction in those numbers that you talked about. So let's say 13.6 million barrels per day. It has ticked a bit higher in recent months, but it's a lagging effect, right? So as we drill fewer wells and complete fewer wells, there will be a lag effect 6 to 9 months later. So we should see that this was probably the peak around 13.6 for the near term. We're not going to fall below 13, but there's a lot of room between 13 and a half and 13, and that's material for the global oil market, price setting, WTI, the ARBs that my colleague mentioned, et cetera. I think, just one last note, I think that Trump has definitely this idea about geoeconomic leverage for the United States as a supplier to the world. I think it's probably more apropos to natural gas and to the huge wave of LNG capacity in the United States that's coming after these FIDs, these final investment decisions that have been rolling forward since he took office in January. In oil, it's not as much leverage in that regard. So we're exporting 4.5 million barrels per day into a global market that's substantially, 103, 104 million barrels per day. So it's influential, but we don't have the same leverage that we do with regard to gas.
Okay. Peter, on that front, let's talk a bit about Australia. Two things. Tariffs, Australia and China seem to be the only two countries who are kind of showing any mettle, really, at least verbally. And we had that deal last week offered by Australia, that little sort of sweetener, if you like, on some of the materials there, which was seen as strategically quite clever. How under pressure is the Australian economy on surroundings of these tariff negotiations, and who has the upper hand at the moment, do you think, of the two?
Well, I think first off, let's paint a picture. We had a rate decision by our governor yesterday, Diala, the Reserve Bank of Australia, and they had no move as far as interest rate cuts. Inflation ticked up from 2.1 to 3.2% within a month, which was very damning, and unemployment is now up to around about 4.6% from 4.3.5%. So these are all going in the wrong direction. Then we look at what the US did last week as far as the deal buying $8.5 billion worth of rare earths and the positioning there. So we are reliant on China. There's no doubting that. They're a major trading partner. We need China, and that needs to be, stamped on everyone's probably, wrist. But the other side of it is the trade-off. We also need America, and we've had a very strong strategic relationship with America from a defense situation. We fought in wars together, and we've fought in many wars together, and we're very much joined in the hip from a geographic positioning. And they have military bases here, and we do a lot of military exercises and so on. So I think it's going to be fascinating what the blowback's going to be from China. Is there going to be any? I would think that President Xi and President Trump and our leader would come to some sort of relationship and say, look, we need to play. The cards are on the table. President Trump's wanting this, President Xi's wanting that, and we've provided services and commodities to both nations, and we shouldn't be penalised with a population of 26 million. So there it rolls, and how it plays out, Diala, I think is just, again, it takes time for all of this to wash through. But I think the strategic relationship between Australia and China can't be discounted, nor can it be ourselves, of course, with the United States.
Absolutely. I mean, the games go on. Matt, we talked about Russian oil. What about Iranian oil? You know, it's so quiet on the Iranian front in every sense. Everything seems to be sort of steady as she goes there, right? We're still seeing the same amount of oil exports, 1.5 million approx coming out. A lot of floating storage, though, oil on the water, right? Sort of taking much longer. Is that impacting destination crude, if you like, and what consumers and what buyers' strategies in any way?
Yeah. Yeah, absolutely. Yeah, no, sort of the Iran narrative's gone off the boil a little bit. I think with everything else happening, we can only sort of hold so many geopolitical things happening at one time. But I mean, you are absolutely right. It is pretty much business as usual. I would say, from a shipping point of view, one of the more interesting things is how the market's sort of navigating the fact that there's been a huge amount of sanctions on vessels related to Iran. So essentially, since the beginning of the year, the US slapped sanctions on Russia, on vessels related to Russia in January, and then has since not really touched them. Now, it has definitely, as we know, it's sanctioned Rosneft and Lukoil, but otherwise, almost all OFAC sanctions have been related to Iran this year. So they've really been going after that. And OFAC sanctions are the effective sanctions in the market when it comes to really wanting to see a behavioral change in a vessel. And that is because generally the ports and the terminals take OFAC far more seriously than they do EU, UK. So the fact that the US has been going over to Iran has seen a bit of a shift. Now, in the main buyer, China, what we've noticed is there's certain ports where they have said, look, we're not touching Iranian crude, and it won't go there. However, the US has sanctioned some ports, Yantai, Dongjiakou, for example. And as a result, we're seeing more Iranian going there, and we're seeing more OFAC sanctioned vessels going to those ports, almost saying, well, this is sort of we might as well lean into this now if we've been sanctioned. But so there's some logistical things happening behind the scenes to try and keep that moving, but fundamentally, it's still moving.
Okay. Clay, let's just look at that survey question that came up a couple of minutes ago. US election results swings to the left. That's referring to the Mamdani win in New York, which was more recently expected, I'd say. Not a surprise, but it would have been a surprise when you heard the rhetoric a few months ago, especially coming out of the Republican Party and Trump in particular, and continued government shutdown. That's dragging. Would you say that the left swing is one thing, but the shutdown also, in terms of economic sentiment and what nervousness is that bearish for oil prices if that continues to be the case? And then, of course, you've got the midterms to think about, which are going to clearly kick in the new year campaign.
It's very clear in our system that that we have this pendulum that swings after the general election to the other side. For the midterms, we're starting the midterm election campaign season effectively now. That'll take place a year from now. So it's on. These are some early indicators about maybe dissatisfaction with the Republican side, but I wouldn't read too much into it. And with regard to the duration of the shutdown affecting the real economy and real oil demand, and I am in no way trying to minimize the effect on millions of people that are having a very hard time with this shutdown. Nevertheless, with regard to effect on oil demand, I'm a bit skeptical, and I think that this shutdown is going to be resolved. It'll be way longer than it needed to be, but during the month of November. I think that the prediction markets actually corroborate that for what it's worth. And so I think just a blip. I don't think that's going to affect aggregate oil demand substantially at all. If I could just take one more moment, I'd like to comment on the Iran sanctions bit that my colleague.
Yes, I wanted to ask you about that. Yes.
Well, it's excellent remarks and observations, but just at a high level, think about where that leaves us now, because it's true. In February, the Trump administration came out with its NSPM2, National Security Presidential Memorandum 2, that explicitly calls for bringing Iranian oil exports to zero, including exports to the People's Republic of China. Here we are 9 months later, they're substantially unchanged. It has not moved the needle at all. Hundreds of secondary sanction actions have been taken since then against certain ports, other oil assets, dozens, even hundreds of persons, as we call these entities, to what effect? And so far from maximum pressure, as they call it, and certainly bringing exports to zero, it hasn't moved the needle at all. I think it's a case study that's important when we think about Rosneft and Lukoil sanctions. And so it might not go exactly the same way, but directionally, I do believe that you're not going to see a significant decrease in those volumes coming out of Russia after the first 1 to 2 months of an adjustment period.
Yeah, and I mean, as you said, China's taking all that Iranian oil, really, almost exclusively.
Substantially
So
100% of it, that's right.
Trump may have said what he said, but surely at this point in the trade negotiations, unlikely to sort of implement something that would cause China that loss, if you like, given
And
given
remember
the other
that
things.
the OFAC, which Matt talked about, exactly right. They basically got two tools there. They've got the general licenses that are made public. They've also got specific licenses, the terms of which and even the existence of which are not made public. So we keep talking about the importance of implementation following the declaration of these sanctions. It's not only on enforcement and whether there will be really biting secondary sanctions on specific buyers to follow, but it's also on whether the Trump administration chooses to grant waivers, exemptions to certain buyers and let them off the hook, which would also be letting Putin off the hook, wouldn't it?
Yeah, continuing to do so. Well, there's the result. Agree that it will be, but yes, 57%, not too high a swing there. Peter, just to go back to you, made a comment earlier about gold and your opening that it's taken a bit of a, since it hit the high, and just consolidation, really, I suppose. Do you see that? I mean, continuing or as a hedge? Would it next, as these question marks over all the other assets continues? Would it reclaim its place, if you want, as an increasingly used as a hedge, or do you think we've hit the high for now?
I don't think so. I think first off, central bank buying has been mind-blowing. What we've seen, Diala, this year, 23 central banks have broken their records as far as purchases for this year.
And China, a lot of buying from China, right, as well. That's including China
and certainly India. India has had huge buying this year. But before 2010, and let's just look at the historical. Before 2010, for 21 straight years, we had a selling of central bank gold. Since 2011, we have had purchasing of central bank gold. So central banks already bought 1,080, 1,051, and 1,089 tons in the last 3 years. And 2025 buying will be on track for their 16th consecutive purchase of the longest streak on record, Diala. So we've got central bank purchasing, annualized rates at the moment running at about 830 tons for the year. And we're on track to buy twice the volume, the annual average seen between 2011 and 2021. So central banks are buying more, retail is buying more, and I think that 10%, we saw that price correction, I think it's just gathering steam at the moment. US dollars taking a run up. Yeah, the 407, 408 for a US 10-year, and I think we're going to see a rebound to the upside. Silver is the one to watch, $65, I think, by end of Q1 of 26, and I think gold at 5,000 is very achievable in the short run.
Okay, we will end there on that bullish note for gold. Thank you to Peter and to Matt and to Clay for joining us today. Coming up in an hour, we have an interview with Alex Vatanka. Very well worth watching. A nice update on his views, at least on the Iran story, and a bit of the regional geopolitics as well, and the domestic situation there. So please do tune in at 12 o'clock Dubai time, at least. Thanks very much, and have a great remainder of the week. All the best.
Thank you, Diala.
Thank you.
See you guys.
All clear?